Every trader, at some point, becomes obsessed with the idea of the perfect entry. It's an emotional pursuit disguised as strategy, the fantasy of catching the exact bottom before price explodes upward, or selling the exact top before collapse. Entire trading careers are spent chasing this illusion, drawing tighter lines, refining indicators, waiting for some cosmic moment of precision that never quite arrives. It feels logical, even noble, but beneath that desire lies something more fragile, the need to be right. And it is precisely that need, Wyckoff observed, that blinds traders to the truth of how markets really move. Wyckoff's genius was that he never sought precision, he sought proportion. He understood that the market is not a single point of entry or exit. It is a living mechanism of preparation and outcome, of cause and effect. Smart money, what Wyckoff called the composite man, does not act in single strokes. He accumulates, he tests, he confirms. His buying and selling unfold in stages, each one revealing a different layer of intent. The retail mind craves immediacy. The professional mind studies proportion. That is the quiet secret behind what Wyckoff called the 1/3 rule, not a formula for perfection, but a structure for participation. The 1/3 rule reflects a deeper philosophy of market engagement. Rather than committing all capital at once, Wyckoff observed that professional operators entered positions gradually, roughly in thirds, as the market confirmed or invalidated their underlying hypothesis. It was not random scaling, but the expression of a disciplined respect for uncertainty. In an uncertain environment, proportion becomes protection. The composite man does not demand certainty. He constructs it through action and observation. He buys a fraction during early absorption, adds as evidence strengthens, and completes the position only when the market itself confirms his view. Each third represents a psychological shift from potential to validation, from belief to proof. This way of thinking stands in direct opposition to the emotional habits of the average trader. The crowd wants instant confirmation. It wants to enter fully, make money quickly, and be right immediately. But the market rewards patience, not conviction. It punishes those who mistake opinion for structure. Wyckoff's 1/3 principle reveals that true timing is never about calling a turn. It is about listening to the market's process of absorption and release. Smart money does not predict the turn, it builds the turn. It measures how much effort has been absorbed before the result manifests. That measurement is always proportional, never absolute. Consider the early phase of accumulation. Price appears weak. Volume spikes erratically. Sentiment remains fearful. Retail traders exit in disgust, while the composite man quietly begins his first third light. Exploratory, almost invisible. He is not buying price. He is buying information. Each purchase tests the market's depth, probing for supply. When the market responds with steadiness rather than collapse, the second third begins. This scaling in is not greed. It is data-driven conviction. Only when supply has been fully absorbed, when the tape begins to move effortlessly upward, does the final third complete the position. The law behind it is simple but profound. Conviction grows with evidence, not emotion. To trade without proportion is to fight the market's natural rhythm. Every campaign, Wyckoff taught, is built in stages, and each stage deserves its share of capital, its share of attention, its share of risk. The 1/3 rule transforms chaos into cadence. It forces patience where impulse would otherwise reign. It teaches the trader to think like an operator rather than a spectator, to engage with the market as an evolving organism rather than a slot machine. The precision traders seek through timing is an illusion. The control they crave through proportion is real. This idea also restores emotional balance. When one divides entries into parts, the psychological burden of being right or wrong disappears. Each third becomes an inquiry rather than a verdict. Instead of asking, "Will this work?" the disciplined trader asks, "What is this action revealing?" That subtle change dissolves anxiety and builds composure. The 1/3 rule, in practice, is less about mathematics than it is about self-regulation. It reflects the belief that discipline must precede profit, and proportion must replace perfection. It is a dialogue with uncertainty, conducted through structure. Wyckoff's contemporaries often misunderstood this principle, mistaking it for mechanical scaling. But the essence of the one-third rule is not numerical, it is philosophical. It embodies the humility to act without knowing, the patience to build conviction slowly, and the discipline to let the market reveal its own rhythm. To the untrained eye, this restraint seems passive. To the professional, it is supreme control. The composite man never fights the market for confirmation. He invites it. Each third entered or withheld is an expression of listening, the quiet mastery of timing that emerges only when one no longer demands it. What makes this rule timeless is its alignment with how all natural processes unfold. Growth, accumulation, even learning itself, follow phases of preparation, expansion, and completion. Markets are no different. They breathe in accumulation and exhale in distribution. The one-third rule simply synchronizes the trader's rhythm with that of the market, transforming chaos into sequence. In doing so, it dismantles the myth of perfect entries once and for all. The goal was never to find the bottom or top. It was to understand the proportion between cause and effect, effort and result, preparation and reward. The trader who grasps this begins to trade not with hope, but with structure, and structure, as Wyckoff taught, is the only true form of control. Richard Wyckoff believed that every movement in the market is the visible consequence of an invisible preparation. Price is never random. It is the mathematical and psychological outcome of a preceding cause, a reservoir of effort stored in the behavior of buyers and sellers. To him, this was not a theory but a law, as natural and consistent as gravity. The *** law of cause and effect ** became the cornerstone of his market logic. If one could measure the cause, one could anticipate the effect. If one could recognize the process of accumulation or distribution, one could foresee the eventual movement in price. It was through this lens that Wyckoff's one-third rule gained its true meaning, for the rule itself is a reflection of proportion between preparation and result. In Wyckoff's framework, the market is a machine of preparation. It spends more time building the cause than expressing the effect. Accumulation takes weeks, months. Markup happens in days. Distribution unfolds slowly. Decline accelerates. The one-third rule exists because the composite man, that collective force of professional operators, understands that the cause is never created in one motion. It is layered, tested, and confirmed. To build a campaign, he divides his activity across the structural evolution of the cause. One portion enters while the cause is still unformed, probing for weakness. Another enters as the structure strengthens, validating the hypothesis. The final portion confirms the cause's completion, the point at which effect becomes inevitable. This rhythm is not superstition. It is the physical manifestation of Wyckoff's law. The relationship between cause and effect is visible only to those who study preparation, not result. The average trader obsesses over breakouts and breakdowns, the public display of effect. But by the time the move is obvious, the cause is already spent. Wyckoff observed that professionals, conversely, measure how much effort has gone into a move before expecting any result. Volume and time are their raw materials. When price remains stable despite heavy volume, it signals absorption effort without result, a growing cause. When price responds dramatically to minimal volume, the effect has outgrown the cause, signaling exhaustion. In this way, Wyckoff's law teaches that success in trading depends less on prediction and more on interpretation, reading the invisible build-up behind the visible motion. The one-third rule operationalizes this law by aligning action with evidence. Each stage of scaling corresponds to a stage of cause development. The first third acknowledges potential. It is the operator's way of saying, there may be sufficient cause forming. The second third confirms structural integrity. When the market begins to demonstrate harmony between price and volume, the early signs of dominance by demand over supply. The final third validates inevitability. The cause has matured, and the operator now allows the effect to unfold. This is why Wyckoff's traders could engage markets with both confidence and restraint. They were not guessing direction. They were measuring readiness. They understood that markets do not move because traders wish them to, but because sufficient cause demands that they must. This principle transforms the trader's psychology. The impatient mind sees inactivity as waste. The disciplined operator sees inactivity as incubation. Time spent within a trading range is not stagnation, but the gestation of the next movement. The composite man, through accumulation, converts uncertainty into inevitability. His patience is not passive, but productive. He knows that cause equals opportunity, and opportunity without preparation is simply chance. The one-third rule ensures that his exposure grows only as the cause matures, never faster than the market's readiness to reward him. This synchrony between behavior and structure is what separates professionals from participants. Wyckoff's law also serves as a moral lesson in proportion. It reminds traders that the magnitude of one's effect must always correspond to the magnitude of one's preparation. The amateur seeks to double an account overnight, having built no skill, no discipline, no cause. The professional spends months building both position and mindset, allowing the eventual gain to mirror the quality of his foundation. Cause and effect, in markets and in behavior, are inseparable. The market reveals this truth daily. Sudden wealth without preparation collapses as quickly as it rises, while growth rooted in structure endures. The one-third rule, in its disciplined restraint, is therefore both a tactical guide and an ethical compass. There is also a deeper harmony between this law and human nature itself. In life, as in markets, most people act in the realm of effect, reacting to outcomes rather than cultivating causes. They respond to price after it moves, to success after it appears, to failure after it manifests. Wyckoff's teaching inverts this relationship. He invites the trader to dwell in the unseen, to value what is forming beneath the surface more than what has already emerged. In practice, this demands emotional maturity, the ability to act patiently within uncertainty, and to delay gratification until preparation is complete. The one-third rule becomes the physical embodiment of that maturity, a structure that rewards observation over impulse. Within every trading range, the dialogue between cause and effect is constantly unfolding. Volume whispers effort, price replies with result. When these two diverge, a story is being told of accumulation when effort outweighs result, or distribution when result outpaces effort. The composite man listens, interpreting these mismatches as signals of preparation. His entries, divided proportionally, are not mechanical steps, but conversations with the market's evolving intent. Each addition or reduction of position is guided by the question, has the cause reached sufficient proportion to justify the next step? This question keeps him aligned with truth rather than emotion. Understanding the law of cause and effect transforms the way one perceives markets. Price ceases to be noise. It becomes the visible echo of invisible labor. Effort ceases to be frustration. It becomes investment in an inevitable result. The trader who lives by this law stops chasing outcomes and begins building them. He becomes, in essence, a participant in the market's creation of cause, not its victim. The one-third rule, born from this law, reminds him that every campaign is not a bet but a construction, and that true control lies not in predicting effects but in aligning with the proportion that produces them. The one-third rule becomes tangible only when observed through the evolving structure of the market itself. Wyckoff understood that markets unfold in phases, and that smart money enters each phase deliberately, guided by evidence rather than instinct. The first phase of entry occurs during stealth accumulation, a period when price seems indecisive, sentiment remains bearish, and the majority of traders are trapped in doubt or fear. To the untrained eye, this phase appears unremarkable, even discouraging. Volume spikes may occur erratically, price may falter repeatedly, and support lines seem fragile. Yet this apparent chaos conceals the quiet work of the composite man. Each initial purchase is small, almost imperceptible, a first third of a larger strategy, designed to probe for supply, absorb weakness, and measure the market's tolerance. It is not greed that guides these moves, but patience and precision. In this early stage, the operator is gathering information as much as capital. Every trade tests the depth of the market. Every tick of price signals the presence or absence of resistance. The beginner sees randomness, The professional sees structure forming beneath the surface. This is the subtle genius of the first third. It allows participation without overexposure, aligning the trader's risk with the market's evidence. Patience is the operative principle, for the cause is still developing. The composite man knows that a premature commitment could distort price or signal intentions to other operators, undermining the eventual effect. Thus, the first third is not just entry, it is reconnaissance, a methodical engagement with uncertainty. The second phase emerges as the market begins to validate the accumulation. Patterns of volume and price start to demonstrate consistency. The early test of supply and demand has shown that buyers can absorb effort without immediate upward movement, and price no longer collapses under sporadic selling. It is in this context that the second third of the position is added, reinforcing the operator's stake. This is not indiscriminate scaling, it is measured confirmation. The trader has observed evidence of demand dominance and now begins to convert observation into meaningful position. Volume signatures, the rhythm of upthrusts and springs, the subtle shifts in effort versus result, all inform this step. Each addition is a translation of cause into action, a bridge between theory and execution. Psychological control is maintained because the operator understands that he is moving in harmony with the market, not attempting to override it. The second third also serves as a mirror to human emotion. While retail traders are often swept by hope or fear, the professional remains detached, guided by observable data. Confidence grows proportionally to the evidence, never prematurely or excessively. This discipline ensures that the scaling process remains proportional, that risk is distributed across phases rather than concentrated in a single, vulnerable moment. The market is teaching, and the large operator is listening. This relationship between measured action and evolving cause is the heart of Wyckoff's methodology, demonstrating that smart money acts not in bursts of emotion, but in calibrated steps. The final third of entry arrives when the cause has reached a point of inevitability. Price has stabilized, volume reflects absorption rather than panic, and sentiment is beginning to shift. By this stage, the composite man has almost fully defined the opportunity. The third is added to capitalize on the validation of the structure, but it is always done with awareness of the overall context. It is neither reckless nor emotional. It is the culmination of prior preparation. Here, the trader converts observation into influence, entering decisively once the market itself confirms the readiness of the cause to produce effect. This final phase embodies the principle that reward follows discipline, that proportion must govern action, and that patience is the precursor to stream profit. Throughout all three phases, Wyckoff emphasized rhythm and observation. The process is not mechanical, it is alive and responsive. Each third interacts with the market's natural ebb and flow, guided by feedback from price and volume. The scaling of positions is simultaneously practical and psychological. It reduces risk, builds confidence, and aligns the trader with the underlying market structure. By dividing entries into stages, the operator maintains flexibility, controls exposure, and cultivates an understanding of cause that extends beyond charts and indicators. The phases are both tactical and philosophical, illustrating that trading is as much about observing nature as it is about executing orders. The three phases also highlight a subtle moral lesson in restraint. The majority of traders are drawn to extremes. They enter fully at the first hint of movement, or they hesitate until the opportunity has passed. Wyckoff's scaling in thirds offers a middle path, a disciplined approach that harmonizes timing, exposure, and patience. It teaches that true mastery comes not from prediction but from alignment, from entering in proportion to evidence rather than impulse. Each phase represents a stage in understanding the market's rhythm, a step toward emotional and intellectual control. The operator becomes attuned to the cadence of accumulation, able to act decisively when the cause matures and the market is ready to reward measured participation. By the time all three thirds are engaged, the position is no longer a gamble. It is a carefully constructed claim on the market structure. The trader has participated in the development of cause, observed the signs of readiness, and added proportionally to the opportunity. The rhythm of these phases mirrors the natural flow of effort and result, embodying the principle that preparation dictates outcome. In this way, the one-third rule ceases to be an abstract guideline and becomes a lived experience, a disciplined methodology for entering markets that balances risk, evidence, and psychological fortitude. Through these stages, traders not only execute positions, they cultivate patience, intelligence, and clarity, transforming uncertainty into structured opportunity. The one-third rule is not merely a guideline for entering the market. It is a framework for disciplined participation, encompassing timing, risk management, and eventual exit. Wyckoff recognized that scaling in carefully measured portions addresses more than capital allocation. It addresses the trader's psychology, shaping how decisions are made under uncertainty. The composite man never acts impulsively, and neither should the practitioner who seeks to mirror his methods. Each addition of a third of position is carefully synchronized with the evolving evidence of the market. Timing is dictated not by prediction but by observation. The operator enters when supply has been tested and absorbed, when volume signals that demand can maintain control, and when price demonstrates the market's readiness to respond. This timing is rarely dramatic. It is subtle, precise, and grounded in proportion. Risk is central to the discipline of scaling. The professional understands that exposure is as much an instrument of strategy as it is a source of potential loss. By allocating capital across 3 stages, the trader ensures that no single decision dominates the outcome. The first third is exploratory, the second confirmatory, and the final third capitalizes on validation. Each increment is both a tactical measure and a psychological buffer, insulating the operator from the volatility of premature commitment. This proportional approach allows the trader to act decisively while maintaining composure. Emotional overextension is neutralized because the rules themselves provide structure. There is a moral clarity in knowing that every action is measured, that risk is controlled by design, and that patience is rewarded by preparation. The logic of exit is inseparable from the logic of entry. Wyckoff's scaling principles apply equally to the management of positions as they do to their accumulation. Professionals often scale out of holdings in thirds during distribution or the final stages of markup, reducing exposure gradually as evidence of demand weakness emerges. This deliberate retreat preserves capital, captures gains, and mitigates the danger of reversal. Volume signatures, divergence in effort versus result, and the behavior of price relative to key support and resistance levels guide the process. Exiting proportionally is not merely a defensive act, it is an extension of the same disciplined observation that governed entry. It reflects the understanding that markets reward those who align their actions with structure, not ego. Timing within scaling also demands acute attention to the subtleties of the tape. A small spike in volume against weak price may signal hidden selling, a precursor to broader distribution. A pause after sustained movement may indicate the final absorption before continuation. The composite man interprets these micro-signals with the patience of a long game. Each phase of addition or reduction is informed by these readings, ensuring that every action corresponds to the underlying cause. By measuring evidence rather than guessing, the operator minimizes emotional interference and maximizes alignment with market reality. The discipline of timing, therefore, is inseparable from the discipline of proportion. Psychological mastery is embedded in the very architecture of the one-third rule. The retail trader is often caught in cycles of hope and fear, oscillating between overconfidence and hesitation. By contrast, disciplined scaling transforms uncertainty into structure. Each third of exposure becomes a lesson in patience and observation. The operator does not act out of anticipation. He acts in response to measurable cues. The market becomes a teacher, providing feedback on the adequacy of each incremental position. This rhythm of action and observation cultivates composure, reinforcing the principle that emotional control is not optional but fundamental to sustainable trading success. Scaling also moderates the temptation of greed. The retail mindset often conflates opportunity with immediacy, seeking to capitalize on every perceived inefficiency at once. Wyckoff's method reframes opportunity as a process. The first third participates without overcommitment. The second capitalizes on confirmation, and the third rewards patience once the structure validates itself. This process instills humility, emphasizing that the market is not a tool to conquer but a system to understand and align with. Discipline and proportion, rather than impulsive ambition, become the currency of success. The integration of timing, risk, and exit logic under the one-third rule produces a holistic trading methodology. Position size, allocation, and sequencing are no longer arbitrary. They are derived from observation, evidence, and measured judgment. Markets are approached as an evolving organism, not a static puzzle. The operator learns to respect the natural rhythm of cause and effect, observing how accumulation transitions into markup and how distribution signals impending decline. This comprehension allows for confident action without emotional overreach, turning uncertainty into calculated opportunity. Scaling becomes a tool for aligning behavior with the structural realities of the market. In essence, the discipline of scaling is the art of proportional engagement. The professional's actions are measured, evidence-driven, and synchronized with the market's evolving narrative. Timing is informed by observation, risk is distributed, and exits are executed methodically. Through this approach, the one-third rule transcends its numerical simplicity to become a guiding philosophy. It trains the trader to act neither too soon nor too late, to balance ambition with patience, and to let the market reveal the optimal moment for engagement and disengagement. In this way, the disciplined application of proportion transforms trading from speculation into mastery, aligning human behavior with the immutable laws of market structure. The one-third rule, deceptively simple in appearance, is perhaps the hardest principle for the average trader to obey. Its elegance lies in restraint, and restraint is precisely what most human beings struggle to maintain when confronted with uncertainty and opportunity. Wyckoff observed that the vast majority of traders are driven by emotion rather than evidence. Hope tempts them to act prematurely, fear compels them to react defensively, and greed persuades them to overcommit. The very qualities that make the retail trader energetic and ambitious also make him vulnerable, as each impulse pushes him further from proportion and alignment with the market's structure. While the composite man divides his entries with calculated patience, the crowd tends to concentrate theirs impulsively, often in the wrong place and at the wrong time. Impatience is the first and most common violation. When price begins to hint at a shift, the untrained trader experiences a psychological urgency to participate fully, as if action itself could manufacture results. He sees potential breakout and wants to be there immediately, committing more than a proportionate amount of capital, or he interprets a minor pullback as confirmation that the time for action has passed. This impatience leads to exposure far beyond what the market has justified, leaving the trader vulnerable to volatility, false moves, and inevitable emotional stress. Whereas the professional views early action as reconnaissance, the amateur interprets it as opportunity, confusing activity with advantage. The result is predictable. Positions built too quickly often collapse before the market has properly formed its cause, eroding confidence and capital simultaneously. Hope, however, is equally insidious. The trader watches price stagnate within a range and believes that persistence will be rewarded. He clings to the idea that because he sees the pattern, the market will inevitably bend to his will. This hope distorts perception, leading to overcommitment in the early stages of accumulation or underestimation of risk when entering during periods of structural weakness. Hope makes him blind to contrary evidence. He misreads volume signatures, ignores effort versus result divergences, and refuses to acknowledge the absence of confirmation. Wyckoff students learned that markets do not yield to expectation, they yield to proportion. Hope without measurement is reckless, and hope without patience is ruinous. The one-third rule is a safeguard precisely against this temptation, a structural antidote to the human desire for immediate vindication. Fear operates differently but is no less destructive. The trader who has overextended his position during the early or middle third becomes vulnerable to the smallest fluctuation. A sudden spike in selling or a minor retracement triggers panic, leading to premature exits or erratic adjustments. Fear magnifies the perception of risk, often transforming minor volatility into catastrophic threats. The professional, by contrast, has proportioned his exposure across thirds, allowing room for temporary setbacks without jeopardizing the entire position. The untrained mind perceives only the immediate threat, losing sight of the broader cause that has been carefully constructed. This imbalance between perception and reality undermines both strategy and psychology, creating a cycle where fear begets error and error reinforces fear. Greed, perhaps the most obvious but also most persistent danger, drives overcommitment in the final phase of scaling. When price validates the cause and moves decisively, the retail trader often abandons proportion, adding excessively in the hope of maximizing gain. In doing so, he ignores the structural signals that govern prior entries and exposes himself to sudden reversals. Wyckoff repeatedly warned against this behavior. The market will punish those who confuse confirmation with certainty. Greed, unlike patience, operates without respect for timing, evidence, or the subtle rhythms of cause and effect. It transforms the final third, meant to capitalize on preparation, into an impulsive gamble. Discipline dissolves under the pressure of desire, and the reward that could have been secured through proportion is compromised by emotional excess. These emotional tendencies are compounded by the human tendency to mirror others. Retail traders often follow the crowd, reacting to superficial patterns, media hype, or the movements of larger traders without understanding the underlying structure. They confuse imitation for insight, believing that proximity to professional behavior can substitute for proportional reasoning. Wyckoff's method, however, demands independent observation and interpretation. The law of cause and effect, the rhythm of accumulation, and the discipline of scaling are impervious to mimicry. They respond only to careful measurement, patience, and proportionate action. The trader who fails to internalize this truth is destined to violate the one-third rule repeatedly, cycling through hope, fear, and greed in a pattern that the market inevitably exposes. Ultimately, breaking the rule is less a matter of intelligence than of temperament. It is human nature to seek certainty, to desire immediate results, and to act emotionally in the presence of opportunity. The one-third rule is a corrective precisely because it counterbalances these tendencies. It forces the trader to act incrementally, to observe rather than anticipate, and to align his actions with the structural reality of accumulation and cause. The composite man succeeds not because he is cleverer or luckier, but because he acts with proportion and patience, subordinating emotion to evidence. Most traders fail not for lack of knowledge, but for lack of self-regulation, allowing hope, fear, and greed to dominate decisions that should be guided by law, rhythm, and discipline. By recognizing these human weaknesses, the disciplined operator transforms apparent limitations into strength. He learns that restraint is not compromise, that observation is not passivity, and that proportion is the ultimate expression of control. The one-third rule, in practice, becomes both a tactical shield and a psychological framework, preventing the impulses that destroy positions while reinforcing the habits that cultivate mastery. To break the rule is to surrender to emotion. To obey it is to align with the immutable logic of the market. The difference is the difference between survival and success, between reactive participation and strategic engagement. By the time a trader fully grasps the one-third rule, the principle transcends its numerical simplicity and becomes a philosophy of engagement with the market. It is no longer a guideline to be followed mechanically, but a lens through which every price movement, every volume signature, and every swing in sentiment is interpreted. The market, in its endless rhythm of accumulation, markup, distribution, and decline, reveals patterns not to those who seek certainty, but to those who observe proportion. Mastery, in this sense, is the alignment of human action with the immutable structures of cause and effect. Each third of entry, each incremental position, is a lesson in patience, humility, and discipline. The trader who internalizes this principle acts not out of hope or fear, but in resonance with the market's underlying logic. This integration begins with understanding that the one-third rule is as much psychological as tactical. Trading is an arena of emotion as well as calculation, and the human mind naturally seeks extremes, either rushing into positions with blind optimism or freezing under the weight of uncertainty. The rule provides a structure to navigate these tendencies, a measured rhythm to balance courage with caution. By dividing exposure across phases, the trader learns to act proportionally, to observe without overreacting, and to interpret signals without being compelled to immediate judgment. Each action becomes an inquiry rather than a verdict, each third of engagement a disciplined response to evolving evidence. In this way, proportionality becomes both shield and compass, guiding behavior in alignment with the market's natural flow. The mechanics of integration require constant attention to cause and effect. When the first third is entered during early accumulation, it is both an investment and a reconnaissance, a means to engage the market while testing its readiness. The second third is added as the evidence of demand grows, confirming that the market structure can support further commitment. The final third, deployed when the cause has fully matured and the effect is imminent, transforms observation into opportunity. Each stage is linked to observable signals, volume patterns, effort versus result relationships, springs, upthrusts, and minor tests of support and resistance. Together, these markers form a living framework through which the operator interprets the market, continually calibrating position, exposure, and timing. Mastery is found not in certainty, but in this disciplined calibration. Beyond mechanics, the one-third rule fosters a moral dimension of trading that is often overlooked. It teaches humility, reminding the trader that no single action guarantees success and that markets are indifferent to desire or ego. It cultivates patience, demonstrating that waiting for confirmation is not weakness but strategic intelligence. And it instills discipline, showing that proportionality and risk control are inseparable from sustainable performance. Every addition and reduction of position reflects not impulse but observation, not emotion but measured judgment. In practicing this principle, the trader internalizes a mindset of structural respect, learning to prioritize evidence over expectation and preparation over speculation. The market becomes a partner, not an adversary, and mastery emerges from alignment rather than conquest. Integration also transforms the trader's perception of opportunity. The novice sees only price movements, chasing highs and fearing lows. The operator sees cause, effect, and proportion, observing how effort accumulates beneath the surface before result manifests. Each third of the one-third rule embodies this understanding, translating invisible preparation into calculated participation. The rhythm of these phases teaches that reward is proportional to preparation, that patience precedes profit, and that discipline governs outcome. In adopting this philosophy, the trader no longer reacts impulsively to every fluctuation, but acts with intention, guided by law rather than emotion. The distinction between chance and strategy becomes clear, and success is measured not in instantaneous gains, but in alignment with the structural truths of the market. Ultimately, mastery through proportion is a holistic integration of knowledge, observation, and psychology. The one-third rule is a method, a mindset, and a moral framework. It reinforces the idea that effective trading requires patience, measured risk, and continual attention to evidence. It teaches that the market does not bend to desire, but that disciplined alignment with its underlying structure allows for consistent participation. Each third of action is an embodiment of this philosophy, reflecting the careful balance between initiative and restraint. By internalizing the rhythm of accumulation, validation, and execution, the trader becomes attuned to the market's natural cadence, capable of acting decisively without overexposing, and of capturing opportunity without succumbing to fear, hope, or greed. In the final analysis, the one-third rule is not merely a tool for entry or exit. It is the crystallization of Wyckoff's teaching on proportionality, discipline, and alignment with natural market law. To follow it is to engage with the market not as a gambler, but as an architect of cause and participant in effect. Every incremental addition, every measured reduction, and every act of observation reinforces the principle that success is born from structure, patience, and understanding. Mastery is not the result of prediction or luck, but of proportional engagement. And the trader who lives by this rule experiences the market as a living system, a disciplined partner, and a teacher whose lessons unfold in rhythm, clarity, and inevitability.